Hello and welcome to this week's episode for Spy Trader Now. I am your host, my name is Ken, and our model portfolio is up 13.31% year to date. Our stock market strength color signal is green, although it is getting very close to a yellow signal. Our goal here at Spy Trader Now is to beat the returns of the S&P 500 buy and hold investor. And finally, this is the first week this year that we have surpassed that return. We are at 13.31 and the S&P 500 buy and hold investor is at 12.12% year to date. Here are some past returns for our model portfolio. If you want to see how I do this, go ahead and smash that like button down, subscribe to my channel, and ring that bell. Last week, the S&P 500 lost 2.12%. You can see here how we've got a pullback very similar to what happened on the last time that we had a 5.7% pullback. One thing I'm calling out here is that you've got a negative divergence. On the MACD, you can see you have a lower high, but on the price action of the S&P 500 candlesticks, you'll see you made a higher high during the same time frame. That is a negative divergence, giving an indication of further downside and further downside correction is ahead of us. We made some trades. Last week was an incredible week for the S&P 500, and we made 3 trades last week. What did we do? Okay, so on trade number 1, on 8/2/24, we bought to close the 2 in-the-money covered calls that we had on our books. When we did that, we pocketed about $2,100. In addition to that, I had 1 long put position, and we sold to close it. These are the exact trading language that is used when the trades are executed on the Charles Schwab website. So on that one there, we made some good cake. We were able to make $1,500, and that was a nice 130% profit for that 12-day trade. In addition to that, we also put on an additional long call. So we bought to open 1 long call, and we did a 580 strike with an expiration of August 15th, 2025. We went out a full year. So this way we're giving ourselves plenty of time to capture some cash on this long call. And we paid a premium of about $21.93. Now here are all the trades that I've made in 2024. If you want to go back and see all my trades going back 3 years, you can head over to this link. It will be down in the description down below. I have currently 3 open positions. We currently hold 200 shares of SPY. We're very profitable by $9,030 or 9.26% for that trade. We've been holding it for 187 days. By the way, I should mention that the way I work the portfolio is as I start fresh at the beginning of each year at $100,000. Now I think in 2025, I'm going to change that to 150,000 because if I do, the S&P 500 has gotten to the point where it's so expensive. When I just do 2 calls and I do 200 shares at 97,000, it doesn't give me enough cash. So I might do a model portfolio of 125,000 or 150,000 starting in 2025 because I need to have a cash cushion in order to buy the shares and have cash for the option plays that I put on top of the shares. So I may have to do a slight change for that coming up in 2025, but let's not worry about that till January. So the other call, I also have a long call that I put on 7/22/24. Now I'm upside down by $591 because I bought it way too early. And the market on that one there and also has pulled back since then. So I'm upside down on that particular one. But the market to me is undervalued right now. So I put on another call, just one long call, and we went out a little bit longer on the expiration on that one there, and we're positive so far by $32. Here is the equity curve of our model portfolio for 2024 year to date. That is a perfect equity curve, or pretty damn close to it. This is the equity curve of the S&P 500 buy and hold investor for 2024 year to date. And here, on a percentage basis, are the two equity curves combined, so that we always want to compare our blue model portfolio against the benchmark, which is the S&P 500 buy and hold investor. Now, I've been telling you guys for weeks that I've been bearishly positioned to profit when the market has a pullback. And lo and behold, the market had a pullback, and we went north while the S&P buy and hold investor went south. Finally, we are surpassing their portfolio, and we are positioned now with the current structure. If this market continues to decline, we will also decline, because I've taken off the puts and I've taken off the in-the-money covered call. But if this market does do a bounce, which I'm expecting, we will bounce a little bit higher, because I've got two long calls in addition to the 200 shares of SPY. All right, now here's the Fed Chair Jerome Powell. What happened? Last week on July 31st, the Fed had their announcement. They decided that they were going to hold rates, but the Fed chair made comments that we're getting ready to do a rate cut come as early as September 18th, which is the next announcement. Now, what is happening with the federal funds rates? As of August 1st, 2024, the federal funds rate, or the Fed rate, was 5.33%. The Federal Reserve Federal Open Market Committee, the FOMC, set the rate at this level during its July 31, which is basically this meeting right here, and leaving it unchanged for the 8th consecutive meeting. The rate has been in this range since early 2022, when the Fed began raising rates to combat inflation. In general, U.S. Treasury yields and Fed policy rates have a positive correlation. So there's a couple things I want you to remember here. Number one, that the Fed rate is 5.33, and that U.S. Treasury yields and the Fed rates have a positive correlation. So in other words, this is because bonds and interest rates have an inverse relationship. So when rates rise, bond prices decrease. For example, when the central bank starts to raise rates, which they're not getting ready to do, folks, they're getting ready to cut rates, okay? But when they raise rates, it's generally a good idea to sell bonds. Well, guess what? If they're not going to raise rates, but they're going to cut rates, you want to do the opposite. You don't want to sell bonds, you want to buy bonds. Let me show you the next slide. Look at what happened last week on this is a 1-year chart for the 10-year bond yields. These are candlesticks right here. So what you're looking at here is 3 charts in one. The candlesticks, well, that's the TNX, which is the 10-year bond yields. The black is TLT, which are 20-year bonds. The blue is the S&P 500, SPY, or referred to as the spiders. Now, normally, when you cut rates, well, the Fed did not cut rates. What did the Fed do? The Fed left rates unchanged, 8th consecutive time. But the 10-year bond yields, this is an auction market. In other words, the market determines what the bond yields are, okay? So what did the market do? The market, when the treasuries went out to auction, they fell off of a cliff, okay? And what happened to the 20-year bonds, TLT? It skyrocketed. Last week, TLT, which is an ETF, folks, that gained 6%, while the S&P 500 lost 2%. So if we had this incredible foresight to know that this was going to happen, you wanted to be invested in TLT or that type of bond product, because you scored heavily during that process. But normally when this happens, now I got a couple of lines in here, they're a little faint. See that line going straight down here and straight down here? Well, this is what happened. You got bond yields, which are the candlestick chart, and you'll see that it went from a high level down to this next line, which is a very low level. What did your TLT and your SPY, what did they do during that time frame? They went north. But the TLT far surpassed SPY during that time frame. So when you are in a position where the yields are dropping dramatically, you're much better off being invested in TLT than you are in SPY. You're going to make more bank during the same time frame when this happens. And this is exactly what is happening right now. The only thing that is catching my eye is that you see this blue line right here? We are at a support level. This line seems to be respected. In 2024 or December, late December 2023, we hit that line and bounced right off of it. And during that time frame, even though we started to go up, SPY started to go sideways, but you had a dramatic drop in TLT. So right now may not be the best time to go and buy TLT because it went to the stratosphere last week. And if the bond yields on the 10-year, if they are indeed going to bounce, you do not want to be in TLT right now because they are going to drop precipitously very quickly, and you just don't want to be caught in that debacle. So keep that in mind. Now, normally when the rates do go down, normally you get both of these products, the S&P and the TLT, rising. But what happened? You got a divergence here, Ken. You've got TLT heading to the moon, and you have SPY starting to travel south. Why the divergence? Let me explain. This is what's going on. It's the unemployment rate. That came out last week. Where are we at? We're at 4.3%. Washington, D.C. Today, the Bureau of Labor Statistics, BLS, released its jobs report for July 2024. The report shows 114,000 new jobs were created in July. 65,000 less were created in June. The unemployment rate rose for the fourth consecutive month, coming in at 4.3. This information is 1 day old. What is that telling you? That's telling you that the system is starting to crack as far as our economy goes. And the market is telegraphing that it is a little bit spooked that the Fed, Jerome Powell, is behind the curve. Okay? So with the Fed, so the 10-year yields, which are controlled by the free market, it's an auction-based economy, the Treasury market, they go out to auction and they're going to bear what the auction will provide for them. Well, guess what? The market is saying no, and it is dropping the yields. And this is what is happening right now. Okay, now we are looking at things from a presidential election cycle theory. Now, what this states is that depending upon the year of the election, you have historical rates of return for the S&P 500 and down here for the NASDAQ 100. Currently, President Joe Biden is in the fourth year of his term. And historically, when a president is in the fourth year of the term, that averages a 6.7% return for the S&P 500 buy and hold investor. Where do we currently stand? The S&P buy and hold investor currently is up 12.12%, giving plenty of room for this market to still fall and still come to that normal 6.7% average. Now, keep in mind that this is a year-end average. We're only into this in August. We're at the summer doldrums. So I would not be surprised to see a correction during the summer doldrums and then about pop up, and then we wind up somewhere between 6 and 12% for the S&P 500 come year-end. Keep that in mind. Okay, what is the bond market doing? The bond market is saying stay out of the stock market for two reasons. Number one, you have an inverted yield curve. This is not normal. This is going to correct eventually. We don't know when, but eventually The longer-term 10-year yields, which are currently at 4.1%, are supposed to be a higher yield for the shorter-term 3-month and 2-year yields, which they are currently not. So we have an inverted yield curve. Number 2, if we look at the 10-year yield from 1 year ago, we are at 4.05. Today, the 10-year yield is at 4.1. That is a rising interest rate. That is also not good. But eventually, this is going to correct. This will normalize. And by the way, once this does normalize, we've been in this inverted condition for 1.5 years, folks. When this does correct, the economy normally experiences a recession and a good stock market correction 1 to 4 months after we normalize. We haven't even normalized yet. So just keep that in mind. All right, where are we at now? CNN Business Fear and Greed Index. There is our friend Warren Buffett, the Oracle of Omaha, probably the best stock market investor of all times. And here on the Fear and Greed Index, where do we currently stand? At 27, very close to extreme fear. And what does our friend say about fear and greed? Well, obviously, you want to buy when there's blood in the streets, and you want to sell when you're over here at extreme greed. So following this philosophy, you're closer to a buy than you are to a sell. Now, what happened last month? I want to show this a couple different ways. This is a seasonality chart that I'm trying to show you. Now, last month, for the month of July, we closed the month out with a profitable gain of 1.14%. Going back 10 years for the month of July, there was a 100% probability that you were going to close the month higher than when you opened the month, which goal accomplished. That happened again. So that actually did happen. Let's go to the next slide. Now you are going to see in the current month, August 2024, we are down so far for the month, which just started, down 3.25%. On a seasonality basis, going back 20 years, you have a 58% probability of closing higher than when you opened. These are the summer doldrums. Now, look over here on the left-hand side. The last time you had the summer in 2023, August, September, and October, these were all 3 negative months, with September being the most negative month of all. Keep that in mind from a seasonality outlook. Next 3 months are more bearish, generally speaking. Or you have basically a 50-50 chance of going positive or going negative. I mean, 58% is close to 50-50, right? So, and if you want to say anything, it's even slightly bullish. But look what happened last year. With these odds, all 3 months during the summer doldrums were negative bearish months. And here you are going back 5 years. So for the month of August, 50%. Going back 10 years for the month of August, 56%. Now, going back 5 years in the month of September, for the last 5 years, the month of September, every single September going back 5 years for SPY has been a negative month. And going back 10 years, it's a 44% probability that September will be a profitable month. So what does that tell you? That tells you we want to be in a bearish condition on our trades for the month of September, from the beginning to the end. So just keep that in mind. Generally speaking, but we do want to put those positions in place. Now we are looking at a 20-year monthly chart for the spiders. And on this chart, and I have a lot of lines and a lot of stuff here to confuse you. Let's dissect this one thing at a time. What we're looking at here is the red and black line. That is the monthly chart for SPY. These smaller diameter lines are just exponential moving averages, just put on there for visual representation. So when you look over here on the far right, or even in the thumbnail where you can really see it broken down, generally speaking, this is bullish. Why? Because the the stock or index that we're following, in this case the Spiders SPY, is trading above all of its moving averages. If you look at all the moving averages, none of them are crossing one another. They're all in parallel lines, and if anything, they're increasing the distance between the two of them. Keep in mind, this is a monthly chart, so things move very, very slowly on this chart because you need a whole month's worth of data in order for this thing to move just one tick. So when this thing starts going south, it takes time. So normally you're going to start having the index go below its moving averages, then eventually you'll bottom, and by the time this all happens, the index, the exponential moving averages will start to conglomerate, and they'll start to do all sorts of funky things like they did like over here. See how they twisted and went backwards right there? Because you went south so quickly. But what you're seeing over here, everything's still pretty much in a bearish condition. But I want to point this out. What do I see? I see a negative divergence on the MACD. So you got a high and a lower high. Follow that time frame up to here. You have a high and you have a higher high on the pricing structure, a lower high on the MACD. The MACD has clearly topped and is moving sideways. Well, I'm expecting that to start traveling south. So that is the expectation. The slow stochastics here is still above 80, but it is below its signal line. And if this market continues to show more weakness, which I do expect over the next 3 months to show more weakness, we're going to start to get something like this, where the MACD is starting to trade below its signal line. Well, the last time that we did that, we had a 25% correction. So it is possible that that can happen right now. So we want to keep an eye and monitor. What do we have here? We have the 5-year chart candlesticks weekly for the spiders. And what is going on here? You can see in the thumbnail real clearly that over the last 1, 2, 3 weeks is when we started to go south in this market. What happened the last time we did that? Well, last time over here, we had a pullback of 5.7%. And you can see that we're about 5%-ish right now. There's a support level right there, and we're getting very close to that support level. What else you got going on? You have a negative divergence on this MACD on the weeklies. You can see a lower high here and a higher high here. So you do have that going on. Now, over here, I want to show you a positive divergence. Here, you go from a high to a lower high on the pricing structure, and you go from a low to a higher low on the MACD. That is a positive divergence, telling you that when you had this correction, which looks like this correction, that was a buy to go forward and hold on, because everything started moving north at that point in time. But here, with this negative divergence, what I'm thinking is that this next pop up is not, I'm buying long now, as I showed you earlier in this presentation. I am positioned long right now. So I am expecting a pop, but I don't expect that pop to be like this pop and sustainable. I expect that pop to come up, and then I'm going to take off my long calls and I'm going to go bearish. And see how this one stopped right there? When we come up and come down, I think that the next one is going to take out this low. So it's going to come up and then it's going to go down further south. That's my personal expectation. Is the market going to do that? I'll tell you right now, the market is going to do whatever it is going to do. Why? Because the market is an 800-pound gorilla. And what does an 800-pound gorilla do? It does whatever it wants to do whenever it wants to do it. So even though I'm saying this stuff, that doesn't mean that it's actually going to happen. It's just my personal prediction. And I'm basing that off of what I am seeing on the charts. And I'm positioning my portfolio in an effort to profit off of that prediction. That's what I'm trying to share with you. But is it a guarantee? Absolutely not. We are up against an 800-pound gorilla. All right, now we are looking at a 6-month daily candlestick chart for the spiders. Here you can see over Thursday's and Friday's action, how things started heading south, okay? But we also have some cycle brackets down here, and we're getting close to this daily low cycle bracket. This may indeed, in fact, even be the low. That is not confirmed yet. We need to start to see this to go up and to start to make higher highs. You have a low and then you make a couple of higher highs, indicating that, okay, that was the low and now you're moving north. We don't have that yet. I am probably early in the trades that I took. But Ken, why did you want to be early in your trades? Why? Because I see support. I see this level of support here, telegraphing to that one. And if that does fail, I see more support right here. So I see support coming in here. I see us nearing a cycle low. So even if I'm wrong or early in my call, I don't think I'm far off. I think I can give this thing a week for it to recover. So judging by what you're seeing on the MACD, this is very negative. We're clearly heading south here. The slow stochastics started to come up. It was north on its signal line, but that cratered, and now we are below its signal line and starting to head back down towards this 20. By the way, anything below 20 is considered value. So generally speaking, when you're below 20, that's when you want to be long the market, generally speaking. Not always true, but generally this is when you want to buy, and up here is when you want to sell from just a general standpoint. Same thing with the MACD. When you're down here below the signal line, especially if you start traveling north like over here, look at the great buying opportunity that you got there. So we want to be on the lookout for this type of activity. All right, now we've got a ratio chart, NASDAQ 100 to the S&P 500. Why are we showing this chart, Ken? The reason why is because generally speaking in bull markets, the NASDAQ 100 surpasses the returns of the S&P 500. So generally speaking, on a risk-on environment, the ratio chart is the one that's in black and red. The S&P 500 is in blue. Generally speaking, when the ratio chart is traveling north, you'll see that the S&P 500 in blue also travels north. When the ratio chart travels south, the S&P 500 goes sideways to south itself. When here, the ratio chart is traveling north, and here the S&P 500 traveled north. Well, look what happened over the last week or so. The ratio chart is falling off of a ledge, practically straight down. I mean, when do you see that type of falling off of a cliff structure? Yeah, in this chart, which is going back a year, you don't see it. So we are way down, and we're down sharply over a very short period of time. This blue line is support because you got to bounce here, you got to bounce here. So we're very close to that support level. If indeed we do get that bounce, the S&P 500 will also bounce. That's why, and one of the reasons why I am putting on and took off my puts and put on calls. I want to capture money during that bounce, which I'm expecting over the next few weeks. So let's see if that actually happens. This is looking very negative here. You can see that on the slow stow, we did reach a bottoming phase. We did come up, surpassing its signal line, and we are now getting above 20. So if this market does bounce, that will pull that up, and that will pull that up too. The histogram that's on the MACD, notice how you got the long bars here, and you have shorter bars here, compared to the MACD still heading south. That is a positive divergence, folks. That's telling you that the energy is beginning to be lost out of the move of the ratio chart. So if that's true, that's going to bottom this and start to pull that up. Well, that's going to be good for S&P 500 as well as the NASDAQ 100. We have another ratio chart here. This is RSP, which is the equally weighted S&P 500 against the SPY, which is the normal cap weighted. Now we have three charts again, three charts in one here. Ratio chart, black and red. S&P 500, blue. In lime green, you have RSP. This is the equally weighted S&P 500. Well, this chart goes back 20 years. What do you got going on here, Ken? You have, from this point to this point, you have a good bull run, okay? Look at the blue, which is the S&P 500. Look at how you go from the bottom left to the top right on the chart, telling you you're making cake being long in that market during that time frame. What happened to the equally weighted during that time frame? It surpassed the normal cap weighted, telling you that when you have a good equally weighted S&P 500, it is healthy for the cap weighted S&P 500. And look what happened recently. On your ratio chart, you went south, completely south. What is that telling you? This is the Magnificent Seven, okay? This is where the Magnificent Seven stocks was basically carrying the market, meaning that the cap weighted was completely surpassed the returns of the equally weighted. That's why the ratio chart has fallen off of a cliff. That's because the Magnificent Seven was carrying the market. It was down to just a handful of stocks, and it shows up in this chart. And we reached a level, this is a 20-year chart, guys, going a weekly chart. We had not reached that low level in 20 years on this whole chart. So this was, down in the toilet. But we're down in the toilet now to the point where we're bouncing. So with this bounce coming up, we're expecting the equally weighted to now surpass the cap weighted S&P 500. You can see here in the MACD and the slow stow, both of these are traveling north and showing strength. So if indeed the equally weighted is going to step up to par here, you're going to start to see the lime green come up above, which is also good news for the S&P 500 buy and hold investor. All right, now we are looking at the VIX, which is the Volatility Fear Index, and there are three ranges. Above this green line is the upper bearish range, where we are currently at. Between these two green ranges here is a low range, but it's still bullish. And below this green line here, where we have spent an enormous amount of time, is the ultra low range, which is bullish. And you can see that just recently we are spiking up, telling you that fear is absolutely increasing in this market. You're seeing it here in the VIX, and you saw it in the CNN Fear and Greed Index. Here on your MACD, you're traveling straight north, and here on the slow stow, you're just kind of traveling sideways. But we know for a fact that fear is absolutely increasing, and you can see it all over this chart. You have not seen readings this high. I had to go back, this is a 1-year chart. I had to go back 2 years to start seeing levels traded on the VIX in this range. So obviously we are way high, but it looks like we've reached a peak and we're starting to come back down. The market, which is in blue, S&P 500, will bounce during that time frame, if that is true. Now, one thing that I want to point out to you guys is cycle brackets. So I do have some cycles down here for the VIX. Like, notice how this low corresponds with that low, that one, that one, that one, that one, that one. It looks like it's about that one right there. So that low, which was right about there, and then you started to get some upward energy on this new cycle, and boy, that really just shot way up during that time frame. So that was just quite remarkable that we saw. Okay, now we are looking at a 3-year weekly chart for SPY, okay? And here I also have cycle brackets down here at the bottom. And I've got major and minor ones, okay? Now, you can see a really nice cycle going from here to here, clearly laid out, which establishes this major cycle bracket right here. Now, this cycle bracket here, the low is yet to be determined, somewhere around here. So we are falling down here. Now, we do have a minor, somewhere in here, and let's just see if this could be the minor, or this could be the minor over here. So we don't know exactly where this low is yet. If this thing starts to bounce, this could be the low established for this one, and it went a little bit long. Or it may not be. It's hard, you know, this is not locked in stone. Definitely not a guarantee, just an indication. But if indeed that is the low and we do have some energy starting to come up here, well, that could be a nice bounce to come up. And here I have what's called the valid trend line. And what I did was I took that cycle low to that cycle low, and I just simply drew a line, and that's that valid trend line. Well, if indeed this low begins to take hold, then at that point in time, we may start to come up and tag the underside of that VTL before we start traveling south down like this, and then come over here, travel down until we reach that low, possibly taking out this low somewhere over here, maybe even down to right there, or maybe down to right there, hard to say, before we start coming back up, okay? So none of this has happened yet. I'm just trying to give myself some prediction of exactly how this market is going to play out. Right now, all we know is that we have 3 down weeks right here, and we can continue to absolutely travel down. For all I know, we're going to travel down until we reach this cycle low right here. It's a little unclear. Now, one thing that we do want to point out is that forever I've showed you my target range. Forever I showed you that we did hit that target, and we did not surpass that target. And we hit the 61.8 fib based off of a Fibonacci extension from here to here. That all happened. So, and now we're simply pulling back into that. Nothing more than this corrective phase here. So we want to just see where this stops out at. Maybe we've reached where we're going to find support. We should theoretically be near at least that support level there. Then we have this support level here. Then we have this support level here. So there's tons of supports all the way down, but let's see where we actually find support. So I want to take advantage of that bounce, and I would like to capture a little bit of profit going long before I start going and heading to more bearish positions again. Now let's get rid of this, and let's go over to the daily chart. Let's go to a 1-year daily, change our cycle brackets to the 1-year daily. Now here, got a lot of congestion. Let's blow that up a little bit, and let's just see if we can see this really good. Let's bring that down. Okay, it's about as good as I'm going to get it, folks. What is happening here now? Well, here I've got a valid trend line that I have established with this line right here. These cycle brackets, I've been studying them this morning, are not the most helpful, okay? So take that with a grain of salt, if you will. What is kind of known is that you have a trading channel between here and here. And we were established in that range. Then we broke out of it, but it was not a breakout. It looked like it was a breakout. Now here's something very fascinating. See this VTL? Well, look what happened when we did the breakout. We tagged the underside of the VTL. Then we came down, tagged it again, and then went down to there on the first day, and now gap down on the second day. So this VTL does have the market is somewhat respecting this VTL due to the fact that we tagged the underside of it and came south. So we know that we're dropping. We know that we got resistance at this VTL. We're early in this game here. I'm just wondering where we're going to find our support. There's support all over the place here. So eventually this market will find a bottom, it will find some legs, and when that happens, it's going to come up. Now, the question is going to be, how much is it going to come up? That is the unknown variable. Now, I want to show you what I did. Oops. Get rid of that. Okay. So, oops, come on, computer. All right, so let's trash that. We want to get out of that, and I want to just kind of maneuver this a little bit. Now, what I did is I took this high right there and that low, and I used the Fibonacci tool. Okay, and which Fibonacci tool did I use? I used this one right here, which is a Fibonacci retracement. So I toggle back and forth between Fibonacci extensions and Fibonacci retracements. But in this case, that is a retracement, okay? So what I did is I wanted to see exactly how much of a bounce we were going to get. And this is 61.8. This line right there. And we got rejection. We just about reached it, tagged it, got rejection. Didn't even quite hit it, but we came close enough that we're going to say that we did hit it. And we got rejection off of that. From that high to that low. Okay? So now, and then we took this low here, took out that low, telling you that this market is definitely softening because we're taking out lows. But I am expecting this to eventually, come to get some legs and then come up and then kind of do a similar thing. Now we're going to have to redraw our Fibonacci extension tool when that happens. Let me show you what I mean by that. So we're going to have to, let's go ahead and activate this drawing. We're going to have to take this and bring that down low, and we might have to take this high to this high over here. Then when we get the bounce here, we want to see if we're going to come up to the 32, 50, 61, or make up 100%. At an absolute minimum, we should make up at least 50% of this high to that low. At an absolute minimum, if with a fairly healthy, well, I shouldn't even say healthy, it's a normalized market before you begin to roll over. If it comes lower than 50, that's showing that the market is very soft. If it comes higher than 50, and then the higher it goes, it's going to be the stronger that recovery is going to be. So we want to kind of measure that out. That's kind of how I'm going to measure to see what's happening. Now I'm in my longs, expecting the bounce, and we want to measure that bounce to see exactly where we wind up. Okay, now we are looking at a spreadsheet that I created just to get an idea of how healthy various asset classes are and the 11 sectors of the S&P 500. Now, on various asset classes, last week we were at 59. This week we're at 56. We are clearly in a yellow condition, and we are softening up amongst various different asset classes. Now, the 11 sectors of the S&P 500, last week we were at 77. This week we are at 62. Well, we're not going to hit a yellow till we are at 60 or lower. So that's why we have a green signal. But we are very close to 60, so you can see that we're right there on the edge. If this market continues to falter, then this is going to slip into a yellow signal on our strength for the S&P 500. We are very close to that signal. We're just not there yet. Okay, that is going to take us to the conclusion of this video. I have just given you guys a ton of information in this monthly wrap-up video. Now comes the critical thinking. What are you going to do with that information? Well, as of August 4th, 2024, market summation, according to me, Ken, your friendly host for Spy Trader Now, we know that the stock market is losing strength and breaking down. Currently, we are in an oversold condition and should bounce soon. This bounce will be good time to exit the longs and put on more bearish trades. And I showed you guys that. Bearish trades, I'm going to put on more puts, and I'm going to take on another in the money covered call. The model portfolio is finally beating the S&P 500 buy and hold investor, which is our whole goal here, is to beat their returns. And we've done that, and we want to stay that way. I hope you got some valuable information out of this video. If you have not done so already, smash that like button down, subscribe to my channel, and ring that bell. I thank you and wish you good trading.